You know, when you buy a share in a company, you're supposed to be buying a piece of the pie, right? A voice in its future. But how loud is that voice really? In the high-stakes world of big business, it turns out some voices are a whole lot louder than others. So today, let's pull back the curtain and figure out who's really in charge.
Okay, so let's start with the basics, the textbook definition. A shareholder is just an owner of shares. You provide the cash, the capital, and in return, you get a vote on the company's future. Simple enough, right? It's supposed to be the whole foundation of our public markets.
But, and this is the big but, is every vote actually equal? I mean, if you own one share of a company and the founder owns one share, do your votes count the same? You'd think so, but the answer, way more often than you'd imagine, is a hard no. And that, well, that changes everything.
All right, so let's dig into this idea of one share, one vote. It sounds so simple and fair. It's supposed to be the bedrock of how companies are run, the thing that keeps everything on the level and ensures everyone is accountable. So that's the ideal. The reality, well, it's a whole different story. See, there's this popular little mechanism called dual-class stock, and it basically throws that whole proportional power idea right out the window. It just completely changes the math. So let's talk about this first big exception to the rule. The dual-class divide. If you've heard of unequal voting, this is probably what you've heard of. It's a well-known system, and it's specifically designed to keep power concentrated with a handful of insiders.
So how does this even work? Well, it's pretty clever. A company will issue, say, Class B stock to the public, and each of those shares gets one vote. But then they'll have a Class A stock, just for founders and insiders, and those shares might get 10 votes each. So you can own just a small slice of the company financially, but still have total control over the vote. It's a wild setup.
And don't think this is some rare thing. It's not. Almost a quarter, 24%, of U.S. companies that went public in the first half of 2021 use this structure. That's huge. It's a major trend, especially in the tech world. Now you can probably guess that a lot of people aren't happy about this. And you'd be right. There's been some serious pushback. We're talking major investors, huge pension funds. They argue it just lets founders do whatever they want with no accountability. It's gotten so heated that major stock indices like the S&P, Dow Jones, and FTSE Russell are now actually restricting or even kicking out new companies that use this model. That's a big deal.
Okay, but what if I told you that dual-class stock, that's just the tip of the iceberg? It's the obvious stuff. There's a much quieter, sneakier, and honestly, a much more common way that insiders lock down control. A hidden layer of power. So that brings us to a really important question. If a company says, nope, we're not doing that dual-class thing, we got one class of stock, one share, one vote. Well, then everything's fair, right? Everyone is treated equally, right?
Yeah, no, not even close. And this, right here, is the absolute core of what's going on. A bombshell report from the Yale Journal on Regulation found that companies grant these special insider rights through private contracts way more often than they do with those dual-class shares we just talked about. This is the real game changer.
And what this creates is a situation that researchers have a great name for: single class in form, dual class in substance. It means the company looks fair on the outside. One stock for everybody, hooray! But behind the scenes, it's operating with a completely different power structure, thanks to these private deals.
So how on earth do they pull this off? Well, it all comes down to what you can think of as a secret rulebook. These are private contracts, totally separate from the public documents you and I get to see. And they basically rewrite the rules of the game.
Yeah, think of it like a board game. All the public shareholders, that's most of us, were playing by the rules written on the box lid. But a few insiders? They've got a separate secret rulebook that gives them extra turns and special powers that nobody else has. It's not a fair game.
And this secret rulebook isn't just one piece of paper. Oh no, it's a whole web of complicated legal agreements. You've got shareholder agreements, nomination agreements, director designation agreements, all these official-sounding documents that do one thing. They lock in control for insiders, no matter how few shares they actually own.
And the power we're talking about here is just immense. It's not small stuff. It's the right to just appoint most of the board of directors, the power to veto a huge merger that everyone else wants. They can even control day-to-day business, like whether the company can issue more stock or take on debt. Honestly, in a lot of ways, this is even more powerful than having those special high-vote shares.
And here's the kicker. This power is incredibly sticky. These contracts can give an insider control even when their actual ownership in the company drops all the way down to just 10%. Think about that.
You can cash out 90% of your stock but still be the one calling all the shots. Incredible.
So, okay, this isn't just some boring corporate theory. These power structures have very real, very dramatic consequences. They set the stage for some of the biggest corporate fights you read about in the headlines. Let's dive into a few of these battlegrounds.
Let's start with a big one. The epic battle over Elon Musk's pay package at Tesla. A court in Delaware actually struck down the deal at first. Why? Because the judge said Musk was a controlling shareholder, meaning the board that approved his massive payday wasn't really independent. But then, in another twist, a higher court reversed that decision.
And get this, the reversal came down to a wild legal technicality. One law professor, Ann Lipton, perfectly described it as a Rumpelstiltskin argument. The idea is that the case wasn't decided on whether Musk actually had control, but because the lawyers suing him supposedly used the wrong magic word in their court filings. It just goes to show you how these power structures can be defended with some seriously complex legal footwork.
Or how about the crazy chess game of a media merger? Picture this. Warner agrees to merge with Netflix. Suddenly, Paramount jumps in with a surprise, better offer. Now the board at Warner is in a tough spot. They might want the Netflix deal for their own reasons, but the shareholders are looking at Paramount's offer and seeing more cash. So what does the board do? Well, an entrenched board might try some high-risk legal moves to restructure the deal just to avoid letting shareholders vote on it. It's a direct power struggle.
And finally, there's this behind-the-scenes war going on against something called proxy advisors. These are basically firms that act like voter guides for big institutional shareholders. They do the research and tell funds, hey, vote yes on this, vote no on that. This gives shareholders a lot of collective power. And because of that, corporate interests are fighting back hard, trying to use regulators to tie them up in red tape and basically shut them down. It's a fight over who gets to influence the vote.
Wow. Okay, so after all that, dual-class stock, secret contracts, billion-dollar legal fights, where does that leave us? Let's boil it all down. Who's really in charge here? What are the big takeaways?
Okay, here's what you really need to remember. First, that whole idea of one share, one vote is often more of a nice theory than a reality. Second, and this is the big one, control of a company can be totally separate from owning it financially. Insiders can do this with dual-class stock, or, more often, with those secret contracts we talked about. And third, all this creates a hidden power structure, that secret rulebook that makes some shareholders, well, way more equal than others.
And all of this leaves us with one final and pretty heavy question. As corporate power gets more and more concentrated into fewer and fewer hands using all of these visible and invisible tricks, who actually holds them accountable? What does that mean for all of us?